Good afternoon and welcome to this Johnson Investment Council webinar, where we'll be discussing our nationally recognized Johnson Equity Income Fund. My name is Jarrett Levitsky. I'm a Senior Managing Director here at Johnson Investment Council. I also am a member of our executive team, and I'm joined here today by Charles Reinhardt. Now, Charles is the lead portfolio manager for our Equity Income Fund. There's no better person to have here in this conversation than Charles. Just to let you know a little bit about the format, there is the question and answer box that you'll notice on your Zoom profile there. Feel free to pop in any question that you might have. I will be asking Charles a number of different questions about the fund. If we don't specifically answer your question, feel free to pop a question in there. I'll take a look at that for you and see if that fits into the time that we have here today. Also, if we don't have time to get to your question, please feel free to send an email to us. We'll be happy to answer that for you. But before we get started and doing a deep dive on the fund, Charles, thanks for being here.
My pleasure. Thanks for having me.
Absolutely. I thought maybe it'd be helpful for people to have a little bit of a context for who you are. So maybe share with us a little bit of your background, kind of where you grew up, how you got interested in finance, and then ultimately, how did you come to Johnson Investment Council?
Sure. Yeah, I'm an Ohio native. So born and raised in Columbus, came down to go to the University of Cincinnati. And one of the big things that drew me to that program was, of course, UC's famed co-op program,
Sure.
which is actually the dual answer to the latter parts of your question. I actually found this industry through the co-op program there once I started here at Johnson in March of 2007, right in time to get a front seat view for the great financial crisis and all that entailed.
I remember that well.
I'm sure, yeah. I was new to the business and still, I think, got a few gray hairs from that one. So it was a very interesting time to get exposure to this industry. And I think that really sparked something in me in terms of wanting to learn more.
Gotcha. Were there any elements of your childhood that just kind of drew you to the investment management business, or any formative experiences that you had?
Yeah, I wish I could say I was a child prodigy and read Graham and Dodd when I was 7 years old, but really I had fairly limited exposure. I do remember my father was in an investment club, okay. And occasionally when he was driving me around town, he'd leave some of their due diligence in the back seat, and I fancied myself a day trader reading through their reports and trying to decipher what a PE ratio was in the back seat of his Toyota.
Oh, well, that's impressive. That sounds like a prodigy to me. Briefly, if you could, at a high level, this conversation is about the Johnson Equity Income Fund. Can you explain to us, what is the equity income approach, and then also maybe a little bit of a historical perspective of how that came about here at Johnson?
Yeah, I'd start by just explaining equity income is basically industry jargon for dividends. So that's really the cornerstone of the philosophy. We want to have a large cap, large US company portfolio that provides a dividend yield greater than that of the overall market. And it really was born out of, I think, our observations and our clients' needs following the tech crisis and the bursting of the tech bubble. If you think back to some of the companies that were the key sources of problems in that market, dividends weren't a common theme among them. So we found that dividend focus serves two purposes. One, it ensures that we're investing in companies that have cash flow profiles that can support a dividend, which is an important quality marker. The other is that, and this is a little misleading at first when you think about the numbers just intuitively, but if you look at the year-to-year return of the S&P 500 going back to 1950, the average contribution of the dividend to your 1 year return is it's mid-teens percentages, 15-18%, something in that range. When you take that and roll it out to 30-year periods, the dividend and the dividend reinvestment is actually about 2/3 of the return in a median 30-year period. So gotcha. The longer your investment horizon, and we have a long-term horizon, the more important that dividend yield is, and the more of an edge you can gain from having an advantage.
And so when you talk about total return, that would be the dividend plus just the price or the value of the stock going up. It's
Yeah.
those two together.
Exactly right. So if you look at just the price return of the S&P 500
Mhm.
and compare that to the total return of if you take your dividends and reinvest it back in the S&P along the way, you have a much bigger return. That two-thirds of that 30-year difference comes from the dividend.
Gotcha. Let's talk a little bit about, there's so many different investment approaches out there. I mean, within the stock market, there's different industries you can invest in. There's international stocks or domestic stocks. You mentioned large cap, large size companies or small. What are we focusing on here with equity income, and what kind of experience are you really looking to deliver to clients? What should clients and prospective clients expect from this approach?
Yeah, they should expect to see a lot of companies in the portfolio that they recognize in terms of name brand, large blue chip type companies. So we're really focused on domestic, large US companies. We will have some smaller mid cap, 5 billion and up type size of companies in the portfolio. Our process kind of begins, and I won't say it ends, but it's 90% focusing on an evaluation of the quality, what we call the quality of those companies. So we're really not looking for companies that won't stand the test of time.
Gotcha.
As I mentioned, we were looking for the lessons coming out of the tech bubble. And one of those lessons was, and this is kind of a famous Warren Buffettism, rule number one, don't lose money.
Right.
And one of the keys to not losing money is focusing on companies with responsible balance sheets that have dominant market share positions in stable industries. And so those are the companies we're looking for.
Okay. And when you invest in those kind of companies, I remember, back during the tech wreck, which was the start of my career back in 2000 to 2002, the term that was used was brick and mortar. That was like a boring, it wasn't fancy, it wasn't faddish. When you invest in those kind of companies that pay dividends, what does that usually look like from a performance standpoint, as far as related to how markets move?
Mm-hmm.
Is that a smoother experience? Is there less volatility, more volatility? What does that typically look like?
So if you look at this gets into a little bit of nuance of what it is that we try to accomplish specifically with our strategy. But if you look at just dividend yielding companies, they tend to not be a lot less volatile in aggregate than the overall market. They do tend to have some dynamics of being older businesses, so more mature, which generally means they're slower growing. And then the highest yielding companies also tend to have more debt on their balance sheet. Those in and of themselves are not desirable characteristics.
Gotcha.
So when you focus just on yield, you don't really have much different risk profiles in the market because you take on less growth and more leverage. When you partner it with quality, however, those types of franchises I was talking about earlier, you get an interesting result, which is that you can get the yield enhancement benefits from the dividend, but you can actually find companies that have about 90% of the volatility of the market. And that really shines up in periods like the Great Financial Crisis,
right,
where things like companies having too much debt on their balance sheet really gets them into trouble. And historically, we have seen the equity income fund shine in those periods. So in terms of what to expect, companies that don't pay dividends, just like the ones that pay the biggest dividends are the slowest growers,
right,
the fastest growers are often non-dividend payers, right? They need money to invest in new projects. So we're going to miss out on some of that in environments where you've really got the fastest growing companies leading the market. We're not going to fully participate in those markets.
right.
However, when expectations change and the market kind of turns its back on those companies, that can be pretty ugly. And so we're going to defend in those environments, and we're going to participate enough along the way that from just this volatility dampening that we can do, we call it out compound, just from point to point, peak to peak, trough to trough, beat the market just by having less volatility, as long as we participate enough on the upside.
So it tends to be a smoother investment experience.
Yeah, exactly. And if you look to the inception of the fund, we tend to capture about 92% of the upside of the market and about 92% of the downside of the market. That doesn't sound like a real magic formula because those are the same percentage. But the neat thing is that just from having less volatility, we can match or beat the return of the market through that volatility reduction.
Right.
So, it's the adage, if the market goes down 50%, it has to go up 100% to get back to where it was. If we can just keep from going down as much as the market in bad times, we don't need to capture 100 or 110% of the upside.
Right. And I think that plays well into our corporate mission.
Mhm.
We say, what we aim to do is provide people with financial peace of mind. And we do that through our planning approach, the services that we provide, but then also the investment approach. It fits very much into that philosophy of bringing clients financial peace of mind. And what I've found out in my career is if there's less volatility in the portfolio, there's less of an emotional reaction to do something drastic when things don't go well.
Mhm.
And that's something that's inevitable. I mean, markets move. March of last year, which was a pretty violent period for the markets. But if there's a general calm, people are more likely to stick to it versus making that emotional knee-jerk decision and doing something that's adverse.
Mhm.
So that's kind of what you're explaining.
And I think that one of the key pieces of that is that no one sends us a letter when the market's about to turn south, right? Trying to pick the quarter when we're going to get the 35% drawdown from the coronavirus is a fool's errand.
Right.
So the best way to take advantage of this edge that we found in the market from quality and yield is to be positioned that way all the time, so that we're always ready.
Yep.
And it keeps our clients from having to worry about, do I want to be in or out of the market this quarter? Because they always have protection and they can always participate.
Yeah, and something I've learned as well from things that you've showed me is that, as the market moves, there's different periods where what we do will very much be in favor and be in style. And there's periods where that's not the case. But when you stretch that over the long run, over an investment horizon, it provides that smooth market-like experience, with market-like returns, which works very much to our clients' favor. Let's talk a little bit about something I mentioned before, which was the national recognition of the Equity Income Fund. And I love to brag on the team. I'm not responsible for this. It's you and your team and the excellent results that you guys have provided. But we've been nationally recognized, and it's the Refinitiv Lipper Award. Can you explain a little bit about what that is? Why that matters?
Yeah, it's probably not Refinitiv Lipper is not necessarily a household brand name,
exactly.
But it is a big name in our industry, and really one of their key. They put the award together, but I think that their key contribution to the industry is that they are a massive returns database. So Lipper tracks the returns of, I think they have over 300,000 different share classes that they are tracking month to month. And they provide performance data to folks like ourselves who are tracking investment returns. And as part of that, it makes sense for them to highlight the funds that they notice are doing the best job. And so for every different fund category, and we're in the equity income, dividend focused strategy fund category, every year they publish awards for consistent risk adjusted returns of over 3, 5, and 10-year periods. So last year we were fortunate to win the 3-year track record award, and this year even more fortunate to win the 5-year award. And their methodology there gets into not just the total return of the fund relative to peers, although that's probably the key component, but also the consistency and things like the drawdown risk. And so if you think about actually the 5-year period that we just had, there's a lot of different market environments in there, right? I mean, the return on the S&P goes from -4 to +30% on a calendar year basis in that period. We had one very close to 20% drawdown in 2018. And then obviously, the market collapse, short as it was in the first quarter of last year. So had some volatility and also some very good years. So I think that really speaks to this power of, and we haven't outperformed every quarter of every year of that, right?
Right,
but
yeah, we wouldn't.
We've participated enough in the up that in those volatile periods, just protecting has allowed us to really out-compound our peer group and do very well in a global peer set. So we're thrilled.
Yeah, congratulations.
Thank you.
You guys have done a great job. And to that, you're the lead portfolio manager, but this isn't all on your shoulders. There's a huge research effort here at Johnson. Maybe explain a bit about the team that's involved, the research effort that we have here at Johnson, and how that helps you as a portfolio manager.
Yeah, it's a great process. We've got 10 folks that work, explicitly full-time on the fund. They have different strategy or different roles, from sector specialists to folks like myself who are more focused on the portfolio construction. And really, a lot of that work is it's driven from what we call a bottoms-up process. So our sector research analysts have very specific coverage areas, the energy sector, the technology sector, and they're responsible for getting really deep into the weeds of the various industry groups and the various companies in there to try and target not just where the best what we call fundamentals or the best prospects are for earnings growth, but also really understanding deeply what the market is expecting from those companies so that we can really identify when there's a mismatch.
Gotcha.
And so the team process looks a lot like this. Our analysts spend an enormous amount of time trying to identify those quality companies, right? There's not any one or two data points we can look at that tell us, okay, computer, what are the quality companies, right? There's a discussion around how much how much bargaining power do they have with their suppliers and their customers, and how much, rivalry is there, and how good is the management team, and a lot of that stuff. Maybe one day we'll get to a point where the computer tells us that. We're not there yet. So we spend an enormous amount of time on that up front. And we've been doing this for a long time, so we've got a pretty good feeling of what those quality companies are. There's always some change and some turnover. The other part of the process is this expectation monitoring, right? It's funny to think of now, but we added an Apple position in the portfolio in 2013, and we did that on a market that was pricing in or afraid that we had reached peak iPhone, meaning that the iPhone numbers were going to roll over.
Yeah.
So when we get an environment like that, where a company like Apple is down 30% on this fear that they've peaked, and it's just the quality franchise it is, I mean, you can really get some special results. Right. Those don't come every quarter, but right. We try to be pretty vigilant to catch those when they do pop up.
And once you identify a security that you want to buy, what's the timing on the purchase decision? And this is another question: is how do you know when you sell a company? So maybe we'll just talk about that really quickly.
Yeah, in terms of it could take us anywhere from 2 weeks to a year to get a company into the portfolio or more. I mean, there's companies that I know we've tracked for multiple years and liked, and just been waiting for the right opportunity to buy.
So it might just not be at the valuation.
Correct. Yeah, we would wait. If the market, if we have a great franchise, but it's just everyone loves it, and there's price to perfection.
Right.
We'll wait. We'll bide our time for a bad quarter or something. But in terms of the actual investment horizon, we try to target 3 to 5 years, and we think that gives us some competitive advantages versus the market. It allows us to view bad quarters as opportunities and not risks. I think of a company like Coca-Cola. There's no unseating that brand in the marketplace, right? There's tremendous brand equity. Now, there's going to be years where people don't go out to eat as much, and their restaurant business isn't going to do well. If that stock's down 5% on that news, we feel pretty confident that over time, restaurants will come back. So that 3 to 5 year time horizon lets us kind of look through a lot of noise that shorter term market participants have to latch onto.
Yeah.
When it comes to sell discipline, it's really the reverse of that timing I talked about earlier. It's when we can no longer justify the expectations the market is pricing into a company, we have to sell it. And that's just about having good discipline and avoiding situations like the tech wreck, right?
Gotcha.
At some point, price matters, and we can't ignore it. But I'd say in terms of mistakes that we make, the most common mistake is to sell something too early, right?
Okay.
We tend to be a little conservative in what we're willing to price into a company. We do that so that we don't have, permanent losses when things get too expensive, but occasionally we do move away from one too soon.
Okay. I remember on that point, I think Alan Greenspan, back when he was the Fed chairman in 1997, said there's a certain irrational exuberance in the market. Well, what the market continued to do, run for another 3 years until the tech wreck happened. Was he wrong? Well, probably not. But the market can still continue to run past the point you might say that something doesn't look attractive as much anymore. So totally know what you're talking about there. Talk a little bit about the portfolio as a whole. So when you look at that, obviously you have a portfolio because you don't know that everything's going to work out. Otherwise, you buy one stock that's going to go up 1,000%. You don't need the other stocks in there. So we're diversified. What does the portfolio look like, maybe from a sector standpoint? And how many stocks are you typically buying, and what position sizes?
It's typically about 40 to 50 stocks in the portfolio. So when we're buying a new position, it's normally in the 2 to 3% range.
Okay.
From a diversification discipline standpoint, we won't hold a position. We won't buy a position at more than 4% of the portfolio.
Okay, gotcha.
Which can create opportunities and challenging periods in markets like the one we have now, where periods last year there was 25% of the market in just 4 companies or 4 or 5 companies. So
say that again, because that's unique.
Yeah, right. So and I think a lot of people probably didn't catch this one in the mainstream media, but or just the financial press didn't talk about it very much. 5 companies in the S&P 500 last year represented 25% of the weight in that investment. So if you buy an index fund, I think the average person thinks, I'm getting 500 companies. No one company is going to drive the returns.
Right.
Apple at points last year was pushing 6% of that index by itself. So we like Apple, but we don't think it makes sense to invest 6% of your wealth in it just because it's a big company. We think it makes sense to weigh the positions in the portfolio based on what we view as the upside opportunity versus the downside risk, right?
Yeah.
So we're making those types of sizing decisions, whereas the market generally makes how big is the company type allocation decisions. So that 4% limiter is a risk reducer over time. Also on a sector basis, it's very rare for us to go above 20% in any individual sector.
Okay, now maybe pause there and talk about why that's important. And the thing I have in the back of my mind is the tech wreck back in 2000 to 2002.
There's I'm sure we could furnish a chart that would show this, but it's best to probably just talk through it anecdotally. We find that when you look at the history of the market, having depending on what year you look at, the classification system changes, but there's generally been around 10 or 11 sectors in the market at any given time. They vary in importance and size of the economy. What we've found is that their importance over time tends to have a sort of mean reverting effect, right? When something gets really big, that's generally a sign that times are really good, and there might be a shooter drop. And anecdotally, over time, 20% is around this level where we've seen some trouble in the past.
In any one sector.
In any one sector. So, I'll give you an example. I think, the tech weight was certainly well above 20% in the late 90s.
Yeah.
The financials.
I think 35% or more stands out in my mind.
Yep. Financial sector was over 20% going into the great financial crisis. I think energy was over 20% in its heyday.
Yep.
Now it's 3% of the market. So what we find that, if we're not trying to evaluate our position sizing relative to the size of the companies in the market. We're doing it based on what we see as the opportunity. And that 20% level, it's I heard someone use the analogy of a rumble strip versus a guardrail. I mean, we have the ability to go over 20%, but our hurdle to do that is pretty high.
Okay. And that's something that within the team is challenged.
Yep.
Talked about within various committees.
Yep, that's right. We spend a lot of time. Well, this whole exercise of putting together a stock portfolio is inherently a a business of making decisions that are trade-offs, right? One stock
cost
versus another, opportunity cost.
Home Depot versus Lowe's.
Exactly. Actually, from our recent experience.
Right.
So there has to be a really compelling relative argument for us to go above that 20% level.
Okay.
The stars kind of all have to align.
Gotcha.
Yeah.
Maybe we'll pause here for a second. I see that we have a question that came through the chat here, and I'll read that so everyone out there can hear. In the past, more larger established companies opted not to pay dividends to retain earnings, which often are not invested in the business growth for various reasons. Is this a trend, and how do you see it influencing the future dividend contribution to returns?
So I think that there's a natural life cycle for even companies that are somewhat vehemently against paying dividends. And I'll go back to Apple as an example. When we actually purchased Apple, the company was not yet paying a dividend. And they had an enormous cash balance. I mean, enough to buy 2 or 3 S&P 500 companies with cash, with no consideration for financing. Over time, even the most successful companies, as they grow, run out of things to invest in, right? That earn the same return as the rest of their business.
So all this money comes in, and they have to make a decision: do we retain it and invest back into the company, or do we pay it out in dividend?
Right. So you could make a case if a company had the world's best opportunity set, it would be a good thing if they held on to all their cash and invested it in the company. But typically, when you see management teams do that for too long, they can start to make some mistakes. And so what we like to see is, and this is really one of the main reasons that dividends is part of the focus of the strategy, we like to see management have some humility around that and really hold themselves to a high bar when it comes to investing cash in things like acquisitions of competing companies, new business lines, expanding into international markets. We really want them to evaluate whether giving that cash back to shareholders or initiating a share buyback, which is another form of it's sort of an academically equivalent dividend payment.
Right.
Whether those types of shareholder return endeavors aren't a better use of that money. And we're very vigilant on that. It's one of our key criteria when we're evaluating management teams.
Gotcha. And you talk about Apple, and you said at the time that we bought it in the equity income fund, it wasn't paying a dividend.
Mm-hmm.
That might strike people as a bit weird.
Mm-hmm.
Why is that the case?
Yeah, I think that's actually one of our key competitive advantages versus our peers, is that we some of our peer funds have a threshold at purchase. They won't buy a stock unless it has a 3.5% yield. That can tend to push the whole portfolio into that lower growing, higher debt type of universe of stocks. We want to capture the dividend advantage at the portfolio level. And so we can have some companies that are maybe, we'll call them future dividend aristocrats.
Sure.
That haven't yet started paying a dividend, but have all of the characteristics of companies that do, stable businesses, lots of cash, lots of financial flexibility. If a company has that capability, we may be willing to buy it even before it has dividend. It's still an exception.
Okay.
But it allows us to have a much broader opportunity set than some of our equity income peers. And the other thing that I mentioned that's unique is that we do view buybacks as dividends. So we do have companies in the portfolio, like right now we have Adobe in the portfolio. They don't pay a dividend, but they buy back 8% of their stock every year. So we view that as a return of capital to shareholders.
Okay, gotcha.
Yeah.
And so it's more that overall the fund itself has enough companies in it that are paying a dividend, not that every single one has to pay a dividend.
Right. At the portfolio level, our investors will have a yield advantage on the index, and all of the constituent companies will have the characteristics of high quality dividend paying companies, although some of them may not yet have started paying.
Okay.
Yeah.
And there's a question that came through about dividend yield, whereas in some of the databases, it looks like the yield is lower, substantially lower than the index. Can you speak to that?
Yeah.
And kind of the nuance there.
Kind of depends on the reporting. a lot of the, like Morningstar, for example, reports the yield of the fund on a net of fee basis. So we would have to significantly, right now the yield on the S&P 500 is, plus or minus about 1.5%.
Yeah.
So, we would have to almost double the index yield to have a net of fee advantage on the index from that standpoint, which we don't think is a good thing to do from a total return standpoint.
Sure.
Now, I will say at various periods, this is a thing that moves in cycles throughout the business cycle and throughout the market environment. There are times when we would absolutely want to have focus more on absolute yield and have a more yield advantaged portfolio. It just so happens that this isn't one of those times. There's not a lot of relative value, and that's not where the strongest companies in the market are. But there have been times in the past where we've had much more significant yield advantages. So I think our ability to, it's sort of like a lever we can move between dividend growth and absolute level of yield.
Yes.
That allows us to be somewhat nimble and appropriately positioned based on where we are in the business cycle. That helps us, with this kind of sustainable all-weather portfolio that we're trying to build.
Gotcha. And there's another question that came through about dividend growth, saying it looks like it's more of a managed dividend growth strategy. Maybe talk about what dividend growth means.
Yeah, dividend growth is it's fairly straightforward term, but the rate at which the company increases its dividend. And it can do that a couple of ways. It can grow its earnings, and then it's got more cash to distribute to shareholders, or it can pay out a higher percentage of its earnings, and so grow its payout ratio. Generally, the market rewards the first category more than the second. So
right.
we're looking for companies that are making more money and therefore paying out their dividend at a higher rate.
Gotcha.
Is there a second part to that question?
Well, I mean, is it too that I think of Procter & Gamble, for example. They've raised their dividend for so many consecutive years and things along those lines. That's one of the things we're looking for as well, is that dividends grow over time to stay ahead of inflation and increasing income stream for investors. Is that a part of the strategy as well?
Absolutely, yeah. And I think that there's certain techniques that management can employ to represent earnings,
yes,
from quarter to quarter, as higher or lower than what the actual cash flow that came into their company. They can't represent the dividend yield, right? That's an actual cash receipt that shows up in our clients' accounts every quarter. So
right.
There's the growth as an inflation hedge, and then there's also, again, this kind of what's a really high quality accounting metric that we can show for the growth of the business over time, and that's the growth of the cash flow showing up in our clients' accounts.
Yeah, which is important because even in down markets, investors are still getting some benefit from the securities that they own through the payment of a dividend.
That's right.
Which is hugely important. Let's talk a little bit about the track record of the fund. It's been around for 15 years, I believe, at this point.
Yeah, the strategy started in 2004 and the fund was launched in 2006. So this is year 15.
Gotcha. So talk a little bit about that, maybe relative to the category or the index and kind of what that experience has looked like.
So there have been, I would say, relative to the category, and that's really what the Slipper Award is about. Our returns are very consistently in the top 25%, top 10%. Right now, frankly, in most time periods, top 5% of the peer group.
Gotcha.
And that's over a number of different time periods. In terms of performance, and I think that's important because there are certain dynamics of how you're doing versus the market that are going to be predicated on what pond you're fishing in, so to speak, right? If you're in a market that's led by a few non-dividend paying stocks, we're not gonna look great versus the market.
That's not even in our universe of
exactly. But the whole peer group is kind of doing the same thing from a characteristic standpoint. So we think that's important, consistently at the top of that group. As far as relative to the index, we have found that we have basically matched the return of the index net of fees since our inception, but with significantly less risk.
Yeah, it's that smoother experience.
Correct. Yeah. So what that looks like over time in more specific examples is that we tend to be in the game in strong up markets and then really shine when the market falls apart. And we think that that's important for a whole host of reasons. And I think it's important to think that we're evaluating right now at the end of a period with very strong, long-term return numbers. So, we're over the last 3 and 5 years, the market's annualized return is in the high teens. So it's a period of time where you wouldn't necessarily expect to have the best outperformance from a downside focused fund. And we've managed to hang right in there with the market. So that's really kind of the name of the game.
And I remember in some of the prior review and outlook events that we've held, talking about the Netflix and the Facebooks and how concentrated things were, as you mentioned before, in those companies that typically we don't own in the portfolio. So when the market's being dominated by that's just different than what we do.
Yeah, I think that, and maybe I could just take a little fork on that.
Sure.
There's 2 ways you can really have a permanent loss in an equity portfolio. You can buy a company that goes out of business, right? That's the quality mantra.
And that's really bad.
Really bad.
I mean, because you're not getting that money
Rule
back.
number 1, don't buy a company that goes bankrupt. Another way is to buy a company that has expectations that are so high that they can never be achieved, even if you push out time and give them a longer runway to get there. And so I'm not saying this happens all the time, but when you see companies that don't yet have positive earnings, that have market caps the size of their entire industry, which is a dynamic that we saw at periods last year. When you see companies that you have to pay $150, $200 for $1 of earnings next year. These are companies where the market has collectively said there is a really bright horizon, and this company is going to achieve a lot of positive things, and that may happen. We're going to miss on a couple of those, here and there, but we're also going to miss the one that is expected to grow at 50% per year for 10 years, and turns out it only grows at 20%. And 20% per year growth is great, but not if the market expected 50.
Yeah.
And so if you buy something at a price that it just can never justify fundamentally, that's that second way to lose money, and we're not interested in that. So it means that we miss, we just don't swing at a few pitches here and there. We might really like a company, but it just is too much of its value is priced up, is in tomorrow's growth.
Right.
And we're trying to pay, we like the growth. We're very focused on getting as much of that as we can, but we're not going to, invest on a wish or invest on the best case scenario.
Now, and I think that gets into investment style and discipline. What you described is a different investment style. It's a different discipline is just not what we do with this particular fund.
Mm-hmm.
It doesn't fit into the universe of what we're looking at from a stock standpoint.
Yeah, and there are great funds that do that, and
Sure.
they've got great track records of their own, but it's going to be a very different experience, right? You're gonna really hit the cover off the ball in good years, and then when the market falls apart, you better have a firm, both hands firmly on the steering wheel, because it's going to be a rough ride. Yeah,
right? And we've seen that in our career multiple times. Yeah. A question came up that I think is a good one. It says, how does Johnson determine what percentage of the equity income approach to hold in an overall retirement portfolio? And I will mention, Charles, that you're on the equity strategy team here at Johnson, and then also I think the portfolio strategy team as well. So
that's right.
This kind of fits in the purview of your world.
Yeah, it's a discipline. So it's a core part of what we do. So it's always, in large cap US stocks are the core driver of long-term returns for most US investors. So it is kind of a bedrock component of most portfolios. Some of the things that we look for in terms of, moving around the position size tend to do with how expensive or cheap the market is in aggregate.
Yes.
Right now, it's a fairly expensive market. Large US stocks are more expensive than smaller US stocks or international stocks, and that's a long-term driver of those relative returns. So that's one of the things we look at. I think the other really important component that we look at is clients' individual situations. I mean, that's the most important thing, and that's why we have our portfolio management group that's highly specialized in taking the centralized research process that I'm involved in, that we just discussed, and saying, all right, Mr. and Mrs. Smith, you've got X, Y, and Z needs over the next 5 years. We're going to build a bond portfolio around that, matching that. It's very customized to individual clients' cash flow needs and risk tolerance. That's the best answer to that question.
Gotcha. Talk a little bit about, you mentioned domestic, U.S. companies, but that there's kind of a global reach in there. And you've talked about before in internal meetings, multinational companies, and that there's actually revenue coming from overseas as well. So maybe speak to that a little bit.
Yeah, if you look at the S&P 500 company by company and look at their annual filings and determine which country is the source of their revenue and add it all together, about half of the revenues of the S&P 500 come from abroad. So just because a company is headquartered in the United States doesn't necessarily mean that it has most of its right, that it's the most important thing to that company could be semiconductor sales in China, right? Like it doesn't. There is increasingly a disconnect between where a company is domiciled and the geographies that drive its economics. It is fair to say that there are some international companies that benefit or have that same dynamic. We've owned some international stocks that look very much like U.S. companies from their revenue mix, and they're large multinational brands that if you didn't know their heritage, you wouldn't know they weren't U.S. companies. Nestle comes to mind.
Right, that's the one I was thinking about as well.
Yeah,
a lot of people think that's probably located somewhere.
Swiss company. They sell a lot of chocolate in the United States. So we will own some companies like that are technically international companies, but have a very high quality management team and meet all our other needs.
Yeah, gotcha. Let's talk a little bit about not only is this a fund that's being managed for our clients, obviously, but that we're shareholders as well. So employees here, Johnson Investment Counsel, you, myself, we're also invested in the fund. I think some people have referred to that as being the chef that eats his own cookie. Why, in your opinion, I have my own reasons, but why is that important? And why would that matter to our clients that we as employees are invested in the fund as well?
Yeah, I think particularly for myself and the other members of the team, if I were a client, I would want to know that we're excited to own the same companies that we're buying for clients. And that's definitely true. I actually sit on the group that handles our internal retirement plans. And I just saw the second quarter reports, and over 3/4 of our retirement plan, our employee retirement plan assets are invested in Johnson funds.
Yeah.
So it's not all the equity income fund, but it's all Johnson funds. That's true for me personally as well. And so it's the most sincere and direct representation of our desire to always be on the same side of the table as our clients. Yeah. And I think the fact that the ownership of the funds extends beyond just the teams that are involved is an indication of the confidence that our employees have in our ability to succeed on our mission, and who has better visibility into what's going on behind these walls than our employees, and they have confidence in the process as well.
Yeah, high level of conviction. And you're right, it aligns our interest and our clients' interests together. I've told people before that I'm literally putting my family's wealth where my mouth is. That when I speak about this approach, I have skin in the game. This is something, and my family's dependent on me to make good decisions from an investment standpoint. So that alignment is so important. And I'd say that people who are not invested in the funds that they manage, you got to question why they wouldn't be invested. I mean, is the conviction not there, or is there some other motivation?
Yeah.
So we like to remove that and think that's extremely important for our clients.
Absolutely.
To do exactly that. Charles, is there any questions either that didn't come through or that I didn't ask that might be helpful as you talk about the fund, or anything we may have missed?
I think that the one thing that we talked around, but that I didn't necessarily speak to specifically, is just that we think that the most important thing, regardless of whether you're a high quality equity income fund manager or a emerging market deep value manager, the most important thing to having long-term success is having and adhering to a discipline.
Yes.
And that means that you do the same process whether the market is rewarding that type of company that year or not, because like I said earlier, no one sends us a letter saying when the environment's going to change.
Right.
And so that means that we have an internal saying that we put at the top of all of our quarterly reviews, but it's that we focus on long-term performance. An investment manager that has a discipline will not outperform every year.
Yes.
And the key to number one is being ready for number two.
Yep.
And so we don't change what we're doing based on the environment. And over time, we have confidence, and has been historically the case, that that's the key to success.
Yes. And I've noticed that, when this approach started, exactly that conviction and that discipline that we're going to stick to what we do and what we do well and what we're good at. And in some years, the market's going to reward that. In some years, it's not. But over the long run, we know it's going to provide that smoother investment experience that aligns with our corporate mission and what our clients tend to seek us out for.
Mm-hmm.
So I appreciate that. I appreciate you and your team sticking to that discipline through thick and thin, and the results that have come about, which again, we've seen that national recognition, which is really fantastic.
Yeah, and I would say I appreciate everyone that's watching today, our current investors and those that may be considering it. We can't do this without you, and we take your trust and confidence very seriously, and so deeply appreciate the opportunity to be of service.
Exactly. And in closing, we do thank you for your time and your attention. We thank you for the questions you posed. We did not get to all those questions, so if there are any that you would like answered, I highly recommend you reach out to your portfolio manager. You can also reach out to our corporate website. There, if you're not a client, there's a link there where you can pose a question and it'll come to us. We'll answer that for you. As you think about this, if there's anyone who might benefit from hearing about this particular strategy and what we've talked about here, please feel free to pass that along. We will be sending around a link where you can watch this video again. I'm sure it'll be posted on our website as well. Two sections of our website I highly recommend visiting on occasion is the In the News section. Charles is featured there on occasion in the media as people seek out his expertise, and we post those in the news section. And then also our perspectives section is a good place to go and see some of our earlier webinars, our different podcasts. You can also subscribe to our newsletter, which might be of interest as well. But thanks again for your time and attendance. If any of this is of interest and you have any friends, relatives, colleagues, coworkers who might need help with any important financial decisions that might be coming up in their life, we would be honored to meet with them and to see an introduction there. But of course, no pressure. Thanks again. Have a great day and enjoy.